Hello and welcome to the Assay. Today, I am happy to be joined by David Franklyn, co-head of funds management at Argonaut. So, David, great to see you again.
Thanks, Amy. Good to be here.
Absolutely. Maybe we could start with a bit of a background into Argonaut and your focus there.
Yeah, look, the unique aspect of Argonaut is it's totally focused on the resource sector, primarily in Australia, but we also look globally. We're based in Perth, and as I'm sure a lot of people be aware, Perth's the capital of Western Australia, which is very rich in resources, major iron ore producer, gold producer, copper producer, natural gas, etc. So it's a good place to be. There's a lot of resource sector expertise, geologists, mining engineers, etc., which is important when you're analysing projects. So Argonaut has three sides to its business. It has a corporate advisory business where we advise resource companies, an institutional stockbroking business, again, focused on the resource sector, listed on the ASX and some internationals. And then the newest part is the funds management business, of which I'm a joint co-head with my colleague Ben Clifford, who's based in Sydney. I run the Natural Resources Fund, whereas Ben runs a more specialised global gold fund. So that's kind of what we do. And we just see that resources is a good place to be in this environment.
Absolutely. And the big news of the day is the trade war, the tariffs coming out of the US, and geopolitics overall and how it's impacting the markets. Can you talk a little bit about how, some of the impacts that you're seeing over in Australia, and how does it impact your outlook on the market?
Yeah, it's obviously been a volatile time, and I think what you see with Trump's style being, a little chaotic is that it creates volatility and uncertainty, and really that's what the market doesn't really like. And I think we've seen that in the last couple of weeks where, in some respects, I think there's some positives in trying to reset the trade environment that the US has sort of evolved to over time. But to do it in a big bang like he did, and perhaps the way that it was outlined, caused a lot of panic and uncertainty. And I think that really had a big impact on markets, and in Australia, a big impact particularly on commodity markets and the resource sector because of the potential impact it could have on China and a slowdown in that economy. Now, I think what we've seen is a bit of a stabilisation, and I think if there's a positive to come out of that whole process, is that the US government was prepared to step back, recognise that it was probably creating a bit too much panic, and to pull back on the tariffs, and really to start to build a process where it can engage in discussions and negotiations. And I think that's really where the market's at now. Everyone's sitting back, taking a deep breath and saying, okay, how do we move forward? But the final point I'd make on Trump, though, from looking at it from the other part of the world, is he is what he is. And so I think you've got to assume that further uncertainty and volatility will be part of the market going forward.
Yeah, absolutely. So, how do you factor in that sort of volatility and that sort of risk into your investment and your outlook for investments?
Yeah. So I think first I'd look at it from two aspects. One is before, as we're heading into those discussions, and you kind of knew something was going to happen, you just didn't know what it was, right? But what we do from a portfolio perspective is to say, well, let's prepare as best we can, right? We're not going to sell everything, but perhaps we'll increase our cash. Perhaps instead of being in smaller, more speculative resource companies, we'll be in bigger producers. So that and really a focus on quality and liquidity, so that if things change in a hurry, you've got the ability in the portfolio to do something about it. So I think we sort of entered April in pretty good shape. We were whacked like everyone else, but when you're in the quality stuff, it tends to rebound faster, and we've certainly seen that. I think the other thing, though, is periods like this of uncertainty create opportunity, and the challenge you have as an investor is to buy the good quality companies at a good price and these opportunities are now presenting themselves in a number of the key commodities that we look at. So that's been positive.
Okay, perfect. And, maybe we can look a little bit more at what those opportunities are. So, where are you finding the most interesting opportunities?
Well, I think, you can't really go past gold at the moment, right? So, uncertainty, volatility, that's where gold has its day in the sun, and we're certainly seeing that. Now, we've had a rally in the gold price for, really more than the last 12 months, and gold prices have risen really significantly. What's been interesting is that you've seen the gold price run really strongly, but the gold equities are really lagging behind, and that's been a bit of a surprise. What you're seeing more recently is gold equities are now sort of taking the rein and running at a faster rate. And I think that reflects where the gold buying is coming from. For most of the last 12 months, it was very driven by central bank buying. So they were countries like China and Turkey, Uzbekistan, perhaps the countries that, and maybe Russia, the countries that didn't really want to hold US dollar assets. And so they're looking for alternatives. What you're seeing more recently is probably the more traditional panic and fear. You're getting more retail investors coming into the market, and a general recognition that gold is a good store of value in periods of uncertainty. So the attraction is twofold, in that equities are still relatively good value because they hadn't really kept in pace with the increase in gold price over the last 12 months. So I think there's still a bit more in gold. So I think gold is a standout. When you look across other commodities, copper we like because it's a big market. It's hard to be manipulated. A number of key sort of growth drivers from general global economic growth. But you're seeing, data center usage, you're seeing increased defense spending, etc. So, we see copper looks really good, where you got good demand growth, but also likely constrained supply. It's such a big market, it's hard to keep up with the diminution that happens every year. And you've also got sort of 40% of production coming out of countries like Peru and Chile, which can be volatile as far as the supply side is concerned. So they're probably the two big commodities that we look at. I think there's opportunities that will emerge. I think the outlook for something like lithium has changed dramatically on the back of energy transition and perhaps an easing of that, whereas met coal and oil and gas, which had really struggled from a lack of investment, I think you're going to see a bit of a renaissance in those commodities as well. So there's opportunities that come from these changes.
Yeah, absolutely. So, as you mentioned at the beginning, you have both a gold fund and a natural resources fund. So with the natural resources fund, how much does kind of that energy transition, critical minerals thematic, how much is that playing into your investment process?
It's still a lot. So if you look at how the way we sort of break down the portfolio in a number of ways, and so energy transition we would say represents about 40% of the portfolio, and then we have another section called geopolitical risk, which is also another 40%, and then we have sort of opportunistic investments and a bit of cash, which counts for the final 20. But our energy transition component is reasonably broad. So it includes some of the commodities that you'd expect, like lithium and nickel and rare earths, but it also includes copper, and it also includes nuclear power. So what we've seen over the last 12 or 18 months is our exposure 12 or 18 months ago was probably very strong in lithium, whereas today it's much more a little bit of rare earths, copper and uranium as our core positions, which aren't as exposed to electric vehicles in particular. If you look at when people were talking about energy transition 12 months ago, a lot were thinking about EVs and as kind of that market, whereas it's broader. It's how does the world generate cheaper, low emissions energy, which is a broader picture, and a focus on baseload power rather than that transport element. And then on the geopolitical, we include gold, but we also include oil and gas, just given how entwined that is in geopolitics, particularly in the Middle East.
It does seem like a lot of the discourse kind of that was centered around the energy transition has also focused more to defense and kind of ensuring that those kind of key metals like the rare earths and stuff are in
Yeah.
supply, I suppose.
Well, I think you're right. Even before Trump's recent announcements, I think where the world was heading was a recognition of you got to be really careful who you buy from and who you sell to, and security of supply. And I think Australia is very well positioned, in that environment. So you're right. When we look at our portfolio, for example, the commodities that we try and steer clear of are those commodities where China has a dominance in both production of the raw material and the processing of that material. And they're the commodities like rare earths and graphite, are the big two that that China do have a dominance in. So what you're seeing at the moment, rare earths in particular are kind of top of mind, where China, as part of their response, is saying, well, we're not going to export any of those to the rest of the world, or particularly to the Western world.
Mm-hmm.
And they basically control both the raw material and the processing side. So countries like Australia, which have decent reserves, and there's other places like Brazil and others, but the price has been so depressed that there hasn't been the incentive to actually go ahead and develop these projects. So potentially there's an opportunity where there will be sort of a bifurcation of the pricing such that Western producers will be incentivized to bring production in line. And I think ultimately that's where the world is heading.
Yeah, absolutely. And so that just brings me to my last question. So really just looking at, some of the key trends that you expect for the coming years. So, what should we be on the lookout for? What's top of mind for you right now moving forward?
Yeah, look, I mean, I think the first thing is we probably need to look through the noise a little bit, right? So I think you're always very focused on what's happening, and particularly at a time like this when we've just been through the first couple of weeks of April, where it's been very volatile. But if you look through, I think the positive side is that what the US is trying to do is it's trying to reinvigorate its economy. And it's very focused on growth. I think it sees a cornerstone of that being the generation of low-cost energy, which had kind of got out of whack as the world moved towards, energy transition. Now, I think you still need to obviously have an environmental focus, and you need to reduce carbon emissions as best you can. But it is a transition, needs to happen over time. So I think the US is all about creating jobs, creating industry and growth. And I think that's ultimately good for demand for commodities and good for the market. The other major economy that the resources rely on is China. And I think China's also at a transition. It's moving from a very export property-led economy and really trying to refocus on domestic demand and having a stronger local economy and local demand base. And notwithstanding what we're going through now, that certainly pushes them further and further in that way. They've also got the capacity for pretty major stimulus, so I think that you see that. So I think ultimately what you're going to see in the US is the commitment to grow the economy, and really to grow out of its debt issues that it's got now. I think you'll see a reduction in personal tax rates. You'll see an increase in indirect tax rates, but really trying to stimulate business. In China, what you're going to see is a stimulus package, which will also be used to maintain growth at its 5% target. And again, I think that's good for commodities. And then the European Union, I think, is also interesting, which has been kind of dead in the water for a long period of time. But, they're being forced now to stand up and say, well, particularly on the defence side, we need to spend a lot more money than we have been to protect ourselves, and we can't rely on others to spend that money for us. So I think their economies and it will also benefit from that. So I think what you've got is a commitment to growth, and I think interest rates are peaked and probably likely to come down over time. So I think when you look through where this might all end, I think it's quite positive, and I think particularly positive for the resource market.
Sounds good. Well, that's
Yeah,
at least a positive note to end things on.
yeah, yeah.
Well, those are all the questions that I had for you today, David. So I want to thank you for joining us here today.
Thanks, Amy. That was good.